Good afternoon, everybody. Before we begin, since we have a bit of technology here with Pigeonhole, I thought it would be kind of silly to have a tech panel without using the technology that we have. So if you could go to the polling question. We've actually prepared some questions earlier that can help us frame this conversation. So I think I'm doing the right thing here, trying to get to the polling questions. Uh-oh. First failure at the test. Oh, no, there we go. What do you think, what percentage of jobs in the banking industry do you think will be lost because of developments in FinTech? If we can get the participants to log in their votes. I think at the moment I have a healthy poll of 2 votes. I'm sure we can do better. Oh, we've now moved on. Let's take a couple more questions. So what percentage of jobs do you think will be lost from banking due to technology? Okay, so if we could we get the poll on screen, please? Oh, well, so I think we are stabilizing now, and it looks like the consensus is about 30% of the jobs in our industry are going to be lost, with some, about a quarter of us saying that it's as much as 50%. So if we go to the next question, I'm going to go to the next question, and it's loading up. Sorry. I think we can certainly think of, oh.
Something's dripping.
Something's dripping. Well, maybe we can change gears a little bit and see if we'll be a little bit more ready in a little while. So let's come back to the questions a little later. But I think, the question that was posed to this panel really, and I think we all meet here as practitioners, is whether FinTech poses a fundamental threat to banking. And so, is the technology and the speed of technology evolution that we're seeing today is fundamentally different from what has happened in banking and finance before. And I think as I was preparing to speak to you on this panel, to me, it really didn't seem an either-or kind of question. And I think it certainly seemed to me that in our living memory, banking has always been incredibly interlinked with finance. And if we can cast our eye back, I mean, if you think about 1950s, we had the credit card, new piece of technology. 1960s, we had the ITM. And Citi is very proud to have brought you the automated teller machines. In the 80s, we started to digitalize exchanges. 90s, we saw electronic brokerages. Technology has always been integral to what we do. And even Mike Milken himself, as a founder of this institute, I remember hearing him a couple of years ago when he said, when I started on the trading floor, I was the computer. What made me really good at my job was that I could calculate yields and prices of bonds much faster than everybody else. And then a couple of years in, the real computer arrived. And then my career started because I had to think about what my job really was. So to me, in banking, we're seeing an evolution of technology-enabled banking. And again, even when I started 20 years ago, the rule number 1 of success on the trading floor is you find a good quant, make friends with them, and get them to help you write your own sort of programs and Visual Basic macros. So however, it's a bit disingenuous to say that nothing's changed. Some things have changed. So what is really different now from what I saw at that time? The first, I would say, is while technology has always been the secret weapon, behind the lines of banking, right now it really has become the business. For instance, Citi as an institution, we spend about 20% of our cost is dedicated to technology. We have our own technology venture arm. We have, innovators working in our innovation and technology lab, and WeWork spaces really trying to dismantle our business model from within. So really, technology is very much the business. The second part of it is regulation. I mean, undoubtedly, every wave of regulation that our industry has gone through globally has actually materially improved our need to retain data, think about who that data goes to and how it works. So for instance, if we think about some of the US and European directives like MiFID and Dodd-Frank, the best execution directives there have really driven electronic trading and algorithmic trading to a point where that's, now there are certain asset classes with only machines making prices, and we don't actually necessarily know what they do. And certainly, again, even it comes to RegTech, KYC, AML, a lot of the regulation has driven technological advancement. The third aspect, apart from sort of technology becoming front and center and regulation, is the fact that, I think about 20 years ago, Bill Gates said we need banks and not banking. And the truth is banking is now being done by non-bank institutions. And what influences banking, a lot of that comes from technology. So for instance, when we look at Apple and mobile phone operators, they have enabled all kinds of mobile banking apps that are now being used by many more people than those who are using brick and mortar banks. We are now streaming APIs, and we're now doing more banking through chat platforms than we've ever done before. So really disruption is, and we're talking about in asset management and investing, we're talking about the Amazonification of financial services. I mean, how are people going to be shopping for financial products? All of that is different. And finally, what I would say to me, sitting here in Asia, when I think about FinTech or when I think about banking, what I'm realizing is that a lot of markets here are really not all that well developed financially in the first place. And what that means is technology has far greater impact on some of these emerging markets that don't have established asset managers, financial players. And so the curve of adoption in markets like India and China is dramatically different. So those were the 4 areas where I'm hoping to get your perspective on, but that's where I see disruption from my vantage point. Just to introduce our panel, we really have a whole gamut of people. We have Teresa, who's an incredibly experienced emerging markets investor, really deep value, fundamental investor. We have Sneha and Lisa, who really are, on some days, competitors, who work in traditional banking institutions whose business model is changing. And we have Lynn. We have Lynn from China, whose business model is technology enabled, who's in FinTech and in finance. And what Lynn does would not have been possible without the technology revolution in China and the growth of financial products in China. So maybe we'll start with Teresa. Can you take us through some of the themes? How are you thinking about it? How would you frame the question? Is this really different?
Yes, so 2 things, I think. I am in asset management, and as an investor we're long-only equity investors, I am investing in a company, and I'm also investing in a stock. And you have to say, is this a good company? Is this a good stock? And so when I know that when I'm investing in a stock, there are a lot of people out there who are traders. And they're not investing in the long term in the company. They're just trading the stock short term. We don't do that. Some people do. It is a way to make money. And I think a lot of that will be disintermediated by machines. But we're investing long term in companies. And so in terms of just when I look at our business itself, I think we've learned a lot from what artificial intelligence and machine learning is doing in terms of understanding what is our own experience and what are correlations that can help us make smart decisions about a company. So for one thing, for example, we look at high quality management. That's great. Only invest in companies with high quality management in very volatile emerging markets. Well, how do you know what's a high quality management? There are only a couple of metrics that you can follow, like ROIC or capital allocation over time. But what about the incentive systems in the company? What about the corporate culture? What about their past history of M&A and post-merger integration? What about their attention to internal controls and using that for KPIs for managers? That's going to be very hard to put into the AI machine, But what we're trying to do is clarify our own thinking on those things and what are the key questions to ask, just as AI would do. So we're learning from the techniques of AI without ever thinking that AI can get there in the emerging markets in the short term. And we can come back to more of that. Then the second thing is looking at companies and the technology of the companies we look at. We do invest in financial institutions, non-bank financial institutions. Happy to say more about that later, but I will just give a little anecdote. My partner is Indian, and she's on the board of one of the best banks in India. They cannot find a board member who knows anything about FinTech. While the bank is moving ahead in the FinTech platforms, they can't find a board member. All of India, where, of course, a lot of the financial software is done for the rest of the world. So,
interesting.
Well, yeah.
I hope that's just a little intro.
Actually, this is something we've discussed earlier with Sneha. And I think as a practitioner in capital markets, you have a lot of questions about the speed of innovation versus the speed of our understanding of that technology.
Yeah, so thanks for that. I think that as you know, we've talked a lot about the progress that we've made in technology and having information at our fingertips and having it speedy, having it efficient, and we've talked a lot about the user interface and how fantastic it is. But I think that what we haven't necessarily spent enough time thinking about is, do we have the ability to harness the power of this technology? So when you look at the interconnectivity of the market today, you look at the explosive increase in the number of new entrants, and then you think about the trading is now being done by high-speed algorithms. For example, in the foreign exchange market, previously banks were the only providers of foreign exchange liquidity for end users. And now about 14% of that volume is transacted or dominated by foreign non-bank players. We're seeing 3 billion of inflows of funds into passive exchange traded products. So with all of that, I wonder whether we've introduced more systemic risks in our financial markets, and I worry about whether we've done enough to harness that power to ensure that our financial markets are stable and secure.
So what is the response? I mean, so when you have these disruptors in markets that offer platforms that, as you said, now operate in very meaningful parts of the market. I mean, what is the conversation you have with your client? What is the conversation you have internally about your value proposition and the adjustments that you're making to deal with that?
So that's a really good question, and in the banking sector, we spend a lot of time thinking about how do we partner with fintechs. I'm sure Lisa would have a lot to say about that as well. But I think what we fundamentally think that the innovation of a fintech can be delivered very well with the scale, the security, and the compliance infrastructure in the regulated and established banks. Westpac, for example, the 200-year-old bank. There's a lot that we could use with that knowledge. And if you partner that with the innovation of a fintech, that could be a really powerful business model.
And Lisa, from your perspective, obviously as a lifetime network banker, how are these topics resonating with you?
Well, my career is a little bit longer than 20 years. So I've actually seen a lot of change. And every time that change comes along, people say, "Oh my God, what are we going to do?" And the fact that you're a 200-year-old institution, we're a 160-year-old institution, we've managed to adapt. Now the question today is really not about whether we will survive, but how quickly change is occurring. So when I think about it, you gave good illustrations earlier about, I started it was a telex machine. How many of you here know what a telex machine is? Okay. Not everybody knows what a telex machine is. When I lived in China in 1980, we had to get on a bicycle to go send a telex, because there was one telex machine at the PTT. So think about it. Think about where we are. That period of change requires adaptability, and it requires a mindset change. So I do worry about regulation. I actually see that the Alibabas of the world are getting regulated now, so things are moving in that direction. Regulation has prevented entrance, just as they have allowed entrance to come. But what I worry about most is our ability to change our mindset. So when I think about large institutions like ours, we process, and I'll throw out a quote, how many pieces of paper do you think an institution like Standard Chartered processes for trade and cash?
No.
We have 37 million pieces of paper. We have 200 million data points. And Citibank is bigger, I'm sure they have more. But I'm not going to compete for that. The real question is, how are we going to change? How do we get people to adapt and be really motivated to change? And how do we use that and move things in another direction? So I think of it in three ways. Mindset, that we're working on that. I just got out of a leadership training program where we're spending 3 days learning to change our mindsets. And I'm going back. It's a really good program, by the way, so I don't want anybody to think it's not. But it's not just about mindset, it's also about skill set. You mentioned the fact that we're becoming technology companies. Now, remember, I started with telex machines. Think about what I have to deal with. It's just amazing when you think about how quickly we have to bridge to new skill sets. So to me, I think a lot about what type of individual do we need in the organization. We can talk about whether we build, whether we buy, whether we co-create, whether we create ourselves. Part of that's all about mindset change, because banks, why we have legacy systems, it's because we wanted to build everything ourselves, proprietary. That's changing, and I'm sure we'll get into it. But the real question is, to me, all this is available. How do we build the skill sets, the human capital within our institutions to take advantage of this? When I think of the job description for a product sales specialist, it's a role we have in banks, they're supposed to know the products and go out and solution with some of you who might be our clients. But what do they need? If I look at the job description from 10 years ago, 5 years ago to today, we need a very different type of creativity, a very different way of thinking, and a lot of curiosity. And so that's what I think about when I think about the change. I think about regulation a lot, trust me. We all do. I think about whether we're going to build or buy, because those are really, the fundamentals. And then I think more importantly about the opportunities for co-creation and how we're built. So I'll stop there for now.
Well, and I think that brings me to Lynn, because I think we all are talking about mindset change and shift. I think in China, most of what's happening is first build in the financial sector. And I think that first build is already coming in an environment of a tremendous amount of data and access to a lot of financial innovation and transactions. So tell us a little bit talk us through Credit Ease's story. Talk us through the environment that you're faced with, and how does that impact your business?
Thank you for the question. Credit Ease, I think, is a very typical fintech company in China quite early. 12 years ago, we founded our P2P lending platform, and has grown to, I think, the world's largest transaction volume every year in marketplace lending. So I think I understand about the topic. It's more about the technology and the business model. So we feel that once you get technology combined with a new business model, which means it enters into a very big market, a potential big market, and you have a right business model, so you combine together and you can break through. So actually, Credit, I think the business model is quite simple. Actually, it's not that new in China. It's a very direct lending. Actually, thousands of years in the world. But we utilize the business model, the structure to serve the underserved people, the lender and the borrower, which the banks are not that willing to do. So we get the chance to develop and a very big market there. So in the whole process, we develop our credit technology. We introduce FICO score into China. We invent our own credit assessment system, and we'll accumulate, I think, a huge amount of data, which the banks are now trying to collect. So we have the data infrastructure, we have the technology, and we use the right model to do person-to-person lending. So that's why we can become the FinTech company. But in the meanwhile, it's more follow the financial principle in China. It solves a very big social problem. Yeah, in the meantime, we also developed the wealth management business. So it's kind of strange why Credit do the inclusive finance and also wealth management. Actually, it's quite natural because we are trying to funding the borrower. And you found the traditional banks, they are not willing to do that. They are not good at assess the very small amount of loan in China. Because China, we are not that process the mature credit system. So we collect the data by ourselves. Even we use some data from the banks, but it's quite fragmented there. So we collect very detailed small data, but together it's huge, and we get more using big data, machine learning, and to analyze the whole data quality. So in the meantime, we need money. So we only have the individual's money first. So for quite some years, we developed our individual lending group of people. And they are small lenders and very big lenders. So people feel very good about the return of the qualified borrowers. So it grew into industry in China, actually, a specific private debt, private credit sector in China, and people invest into that. So we accumulate also a big group of lenders and then grew them into the wealth management business. We cross-sell insurance, we cross-sell mutual funds, and also some alternative products to our clients. So we also grew to the top wealth management company in China. So we think the high net worth individuals are also underserved in China because they don't have enough financial investment choices there, and the service is not that satisfied. So we enter into the two big sector in China, and we combine them quite, I think, perfect together. So that's Credit's finance and technology side. And we utilize technology a lot indeed, because when we do the investment products, in China, we also face the lack of transparent information, the disclosure of the funds. So we develop our own AI FOF system. We collect the huge data of the private sector managers and the investors and the financing companies. So millions of companies there, and we can deal with the maybe 10 million data in 1 minute to replace many manual work there. So I think return to the question about technology, the FinTech company and the traditional banks, institutions, I think we are more complementary to them, and we enhance and we do help the underserved different segments of people. Yeah.
Thank you. I think that was very interesting. And since you brought us to China, maybe, I mean, I heard Lisa speaking nearly, well, to me it sounded pretty perfect Mandarin. I don't know. Lynn is in a better position to judge. You spent a lot of time thinking about China. You do a lot of business in China through your transaction services. How do you see the evolution of the investment environment, the asset management industry, the client footprint in China?
From a FinTech perspective, we see a tremendous amount of development, and actually it's very exciting. I mentioned Alipay, Alibaba earlier, and it actually offers a very interesting thing. And when I think of India and China, I think of China as being a large country with a lot of government influence, and yet the development of FinTech has flourished in a more private sector, which is really quite fascinating. And when you look at India, actually, it's been driven by government imperatives, financial inclusion, demonetization, et cetera. I think I said that wrong, didn't I? Demonetization. So it's a very interesting comparison. But when I look at China, I see large platforms being developed. So Alipay, Tencent, et cetera, are developing large platforms and able to mobilize people very quickly. We've actually co-developed with Ant Financial, something that maybe you've read about, which actually supported financial inclusion, the remittance of money from Hong Kong domestic workers to their families in Philippines. And that was a co-creation, a blockchain co-creation, which is quite interesting. So there's opportunities to co-create. But back to your question, to me, China offers a tremendous opportunity given the size and breadth of its footprint, the speed at which it is able to mobilize, and I would go back to both mindset and skill set. The focus and ability to launch products in a very rapid, focused manner is quite unique. And I think that helps to launch China as one of the premier locations for AI, for FinTech, for a whole host of things. But we have a really big opportunity to co-create. And whether it's co-creation with Chinese companies or others, there's a great opportunity for financial institutions to protect what they do, not even protect, to continue what they do while changing the how and the how they do it.
Yeah, and I think certainly from my seat in the institutional market, we see a tremendous thirst for partnership and, to some extent, I think a healthy amount of knowledge transfer. But I think what I think about, when I think about the investment environment in China is when we think about capital markets products and savings products, we think about them as managed by institutional managers. And certainly in China, the private funds market is developing. But my sense is that ordinary people in China are not going to be saving that way. And so I think, to me, FinTech, platform, and robo-advisory are actually going to be the predominant mode of investment. And so we need to think about our client footprint. We have to think about our engagement, not necessarily with traditional wealth channels, which are, of course, our bread and butter customers, but with the digital natives and platforms, which will be, I think, providing some of those services. Let me pick up the point on partnerships that you've mentioned. I know, Sneha, you talked a little bit about partnerships and the ability to sort of redefine the value chain. Can you talk us a little bit through that in your work life?
Yes, I would love to. But before I do that, I do want to have a little bit of a debate with Lisa about the point about India versus China.
Great. I love it.
It remiss of me to not
She
talk
knows
about
India
that.
a little bit better than I do.
So when you talked about the difference between India being very much government-led.
Well, go ahead.
I think
I do boxing.
Ladies.
So with India, actually we've seen an explosion, maybe not to the same scale as China, but an equal amount of explosion of the technology and the innovation in the space. But I think it's despite the government, not because of the government. So for example, demonetization led to you know, Paytm and, you know, FinTechs like that coming up, talking about changing the ways that transactions are being done. So in India, more than 90%, I forget the number, 90 or 98% of transactions were on a cash basis. And with the demonetization, we suddenly had all these new modes of how transactions were done. So I think it's different.
So maybe just to clarify what if the demonetization hadn't happened, would those fintechs have sprung up as quickly?
Maybe not as quickly, but it's the evolution of it. India is certainly behind China in that, but whether, I don't think that's the question. It's how much and how quickly.
I actually applaud the fact that Aadhaar and UPI and all that have been launched in a very organized fashion. I think it's actually a positive thing. So when I look at how India has evolved, to me it offers a lot of excitement. It's just a different, I was just commenting on the approach,
I think
not the outcome.
Oh, it's okay.
Well, if I can, I think there's a little bit of an untold stories because before November 7th, 2016, the Indians did fingerprint 1.1 or 1.2 billion people. They did have the UPI numbers. Paytm was already in place. The regulations for automatic banking transactions were already in place before Modi demonetized. So all of that was in place.
Exactly.
And then when all the money went into the banks, after that it started going into mutual funds. And then the mutual funds created the SIP programs where people could put money in a weekly, quarterly, monthly basis into mutual funds. And what I think is interesting about India is that the capital markets are developing with skilled institutional investors as the intermediaries between the individuals and the investments. And in China, what is a little bit terrifying to us is that it's such a retail market. It's every mom and pop there investing in a company, and they don't know the ins and outs of the companies. They haven't looked at the margin and how it's evolved over time. They haven't looked at the quality of management, and they don't have corporate governance standards enforced by the government so that these moms and pops can be taken to the cleaners by people who have accounting a little bit off, or they upstream, they downstream, they parallel. And that's, I think, where China really needs to up its game, because India, you have lots of institutional managers of money, and in China, it's many flowers blooming with the government not having paid attention to corporate governance, and it is very scary.
Well, let me again, that's an interesting point, because where I was going to head next is really that regulation friend or foe point, which I think you've brought up, because as I said, I think from my vantage point, I mean, I think certainly technology does enable a lot greater transparency, which can then feed into changes in governance and behavioral change. Equally, where I sit from, and for those of you that, those who know me, every day I deal with complaining employees who can't stand regulation. And yet, again, to my mind, a lot of what we've done with data, a lot of what we do around analytics, around our clients, around client behavior modeling, prediction around cyber, spire phishing, I mean, tons of that comes not because we wanted to do it, but because we're being regulated into it. And that's spurring a ton of innovation. So can we think a little bit about, again, maybe I can go back to Teresa, because you do deal with this all the time as you think about governance of your companies. Is regulation a friend or foe, and is it enabling technologies that are helping you invest better in businesses?
Yes, so I'll answer for me, but I think what you're saying is fascinating, that all the regulation of banks has actually led to some innovation, which I think is terrific. In my business, I really care about capital markets regulation. For example, the Chinese just changed a regulation on companies being able to suspend themselves on the stock market. Fabulous. That's a step in the right direction. I like it very much. They promised, I think 5 years ago, in a 5-year plan, to have corporate governance as one of the top 10 items. It totally fell out. I think just like they need to address IP protection, they need to address investor protection. India does address it, but kind of backhanded ways and shoot themselves in the foot. So they said, okay, we need to know every meeting that a company has with every investor. It's like, oh, seriously? So if we're going to go look at a company, it's going to then be registered on a website that we're looking at that company, and then all of those guys with a dog and a computer are going to come in and front run us, and then blackmail us because we're going to, which they do in India when they know you're buying shares in illiquid companies. So that, crazy, but the SEBI's frustrated that they haven't gotten anyone for insider trading. Well, then get real insider traders. I mean, that's not a problem. So yes, I think what distinguishes emerging markets from developed markets is that the institutional depth is not as great. And that's actually why it's kind of fun. But that's also why we like to see forward movement in having reasonable regulations that are put in place bit by bit by bit. I was sort of present at the creation of the Chilean markets, where they did all sorts of things right over periods of time. Every 6 or 7 years would look at what happened, how the rules affected trading, and then redo the rules. So you see countries evolving quite nicely. But in Asia, I think we do need to see more of it. And the Taiwanese, for example, do a great job on corporate governance, and that could be an example to countries that don't, like Korea and I think China.
And Lynn, do you, from your seat in China, what is the regulatory environment that you feel that you're operating in, and is it changing?
Yeah, quite a clear trend that Chinese government are trying to put much more efforts to strengthen the regulation in, I think, private sector, also licensed financial institutions. So recent years we have seen various regulation policies come out to very strict on financial services. I think the government tried to set more standards and improve the entry barrier of the certain business models there. And actually, as the players in China, which we quite welcome this more strict regulation, because in China, many people try to do things by themselves. Not use the professionals or institutions. So China is more of a retail market, like Teresa mentioned. So people try to do investment, maybe stocks, maybe real estate, property, like that. But it's not that scientific, or even they are facing quite big risks there, actually. And this environment, the government can do more to set up the high entry level of these players. So I think as the leading players in China, people quite welcome the regulation to get the just the so-so or not good managers out of the market. Because it's not imaginable, some private funds in China can very easily get maybe tens of billions of RMB in a single year, but they soon lost a lot of their AUM. That's because the money is not long-term money, and people are not that value-driven. People just try to grasp some opportunity, maybe a very big pre-IPO project. So that's the very early stage of China's wealth management industry and also the asset management industry. So the chances that the top managers, they get good chances. And gradually when people maybe learned some lessons, especially recent years, or maybe people see some news in China's private fund sector, risks already began to be very clear there. And the investors are educated. So I think the regulators should do their job to set up the industry standard and to do the qualification job of the players. But the industry, we should do quite a lot of work on educate the market, educate the investors, and the professional institutions, especially independent wealth managers, should do this for our retail clients. Yeah, really huge money from the individuals try to do good investment, but they should have very reliable and professional institutions to help them do that, do their asset allocation, do good services, and do the long-term services for their family. So I think it's a good thing to get a more healthy market from the government, and the leading players in the market should also do our job there.
Terrific. Well, let me take a step back and shift gears to the really fundamental question here. As you know, as we've spent a lot of time on geography and regulation and a few things, really let's think about our business model and our value chain. I mean, when you think about your business, Lisa, what are some of the areas that are getting most disrupted? What aspect of transaction banking is sort of the ground that the traditional financial institutions are retreating from, maybe, or that is under?
I don't think it's a matter of retreating. I think it's a matter of cooperation. It's very easy to say that there are new fintechs that are entering and will eat our lunch. But I think you have to look at it a little bit more holistically. When I think about it, the way I look at it is, what do we provide? What is our value to a client? And why do they want to bank with a bank versus another type of institution? Some of that, over time, banks have eroded their own value just in terms of losing some trust. But the fundamental thing has been trust. And we are regulated. We do hold. We have fiduciary responsibilities. We are governed. But that will not keep us in the game. What does help, though, is the fact that we have a full value chain. We look across a whole horizon. We have the resources. But what will get us out of the game is we don't start thinking about how we cooperate with players who can be much more nimble than we can be. So the way I think about it is that we have a number of choices to make, as I mentioned earlier. We can continue to build proprietary solutions. We've done that. They're heavy, they're costly, they take a long time to roll out. We could buy, that's another option, or I should say, these are not single solutions. We can work with people who have those capabilities and work with them to develop other capabilities. So when we think about our future and staying in the game, it's a combination of all of those things. And then there's a final thing that actually is coming about a lot recently. My business is more on the transaction processing side. It's trade, cash, and securities services. We start to look at how our customers, obviously we've always looked at how our customers are behaving, but what we do see, we look very closely at supply chains. And supply chains are changing. We see a drastic change in time to market, production locations, where customers need to have money to make their payroll, all these really boring things that keep a company going day to day. And with the shrinkage, with things like 3D printers that are coming about, we see production moving, opportunities to produce and change. We're looking more at how customers deal with their suppliers and their buyers, and we're talking about the ecosystem. How do we bank a full ecosystem from beginning, middle, all the way to the very end user? Very few institutions have that ability to cut across a full ecosystem of buyers, sellers, suppliers, logistics companies, et cetera. So what we look at when we're thinking about our future, and we actually did a picture of the future, what it would look like, how people might be working with each other. It was actually kind of fun to do. Was really a place where supply chains are shrinking, where we see people wanting to access a variety of different solutions, and we become a platform. We work with platforms, and we also become a platform. The problem is things have changed. It's not black and white anymore. You know, bank in the old days, trade finance was 4 boxes on a piece of paper. Now it's a bit more complicated and more exciting, too.
Well, I'm going to make one more attempt at using technology, although the laptop's locked in, so maybe somebody could help me get to it. But I think in that platform world, we do need a different set of skills. And I know that's something that Sneha has brought up in some of our conversations, something very close to your heart. What do the skills for the future look like?
So I think that I wanted to also pick up on that and the point that Lisa mentioned, and I think a number of us, I think Teresa, you've also brought it up, is really around how the future of finance is about creating that social conscience. I think that there is still a perception amongst many people, particularly non-finance, is that finance is full of fat cats. And I think that whilst there's been a lot of work done by banks and regulators, and we've talked about regulation, I don't believe that that's the only answer. I think a lot of work needs to be done still on setting the right tone at the top and getting the right culture in the organization. I think that every single person in the organization needs to feel that social conscience. They need to understand how are banks actually contributing to the community, to the economy, and to the world as a whole. I don't know whether banks have done enough of a job of articulating that contribution. And I think that that's one big thing that we need to do is when we're thinking about rebuilding for the future, we're innovating, but we also need to create that sense of social purpose. And that will help us to attract the right talent, because the young people of today, they don't want to work for the financial industry primarily for those reasons. It's not seen as innovative, and it doesn't have a social purpose.
Right, so a future where finance is a platform, a future where finance has a social conscience. Teresa, what does your future look like?
Well, I think it's I would agree that talent is extremely important in both the companies we invest in and our own companies. But the future is, I think, going to be the human and the machine working together to create value in the world. And if you're not creating value, both in a larger sense as well as in a shareholder value, then there's not going to be much of a place.
Great. And Lynn, from your perspective, what is that fintech-enabled future? Is a bank a friend or foe to somebody like Credit Lease? And how does that play out in the sort of institutional versus retail space in China? Or what are the ambitions for a company like yours beyond China?
I think it's not an absolute choice, but we try to be comprehensive innovation in the whole chain of financial services, as long as we are solving a big problem. Yeah, people face challenge, and we try to solve the social problem. So I think it's more about the business model and the how you position yourself to be both commercial and social beneficial there. For Credit Lease itself, I think still as an independent fintech player in China, but we cooperate with a lot of financial institutions in China. And we also help our industry and our clients to invest into the global fintech opportunity. So we try to bring the old economy money more into the new economy. So technology is the most important trend. And we try to help our wealth management clients and our ecosystem partners to invest more into the new technology economy. So that's, I think, the change of the China society, the big economy. So we try to get the maybe the last generation to next generation people put their money into technology through investment of their transaction. Yeah.
So if we sort of, I guess to us in the financial industry, I don't know if we mark 10th anniversary of the financial crisis. So if let's say we sat here 10 years from now? Are we going to have maybe a technology-enabled crisis? What do you worry about? What are we going to talk about 10 years from now? And any takers, Teresa?
I think it's very possible. I was just saying to someone, I was in a kind of inadvertently at a blockchain seminar in San Francisco at the end of last week, and what they were talking about are all of the mistakes that are made in the coding that are then there forever. And so you're still going to have human error, and you're still going to have fat finger moments, even more so. I think one of the waves that we're going to see is what happens with ETFs, which are really minorly technology, right? It's not a big technology breakthrough, but with so much money going through exchange-traded funds, with the change in global liquidity, we could see a tsunami effect in the markets in general. But debt exchange-traded funds, when the liquidity of the debt in emerging markets is tiny, I mean, that's ripe for a tsunami, right? So just a small reversal, and you can get hugely magnified effects. So I think we might see it more quickly than 10 years from now.
Lisa, anything that keeps you up at night?
Well,
Other
not
than
about
all
not
this
about
changing.
Yeah, changing. Well, you asked what it might have changed. Maybe there'll be a robot sitting here and having this conversation instead of the four of us. I don't know. I mean, that's a silly answer. But when I think about it, I do think that the way we relate to people with each other will change. And I have examples of that with my daughter who interacts differently with her banks and with her financial partners, let's put it that way, than I do. So I think there'll be a very different social interaction that will be required, and that's what we're kind of thinking about. Maybe the treasurer will be by the beach able to make a payment. I don't know. But I do know that no matter what it is, we have to be on top of the risks. We have to think about how blockchain might deliver security, how something else might be helping us to move, concentrate, and invest funds easily for our customers, because those are the types of things that stay the same. The needs remain the same. The how's going to change.
Sneha?
I think the one thing which I can say for sure is the future of finance is exciting. It's never been more exciting. The next 10 years are going to be very different from the last 10 years.
Great. Well, on that thought, it's very lucky that the next panel is about the future of jobs, because I think despite the epic fail of technology, the one thing we've learned is about, I guess, 1.5 of us or so will be looking for another job for sure. So thank you all very much. We're all very grateful for your insights. Thank you. And thank you to Milken for including us.